AutoNation's new car sales are down. Their electric vehicle sales just completely fell off a cliff.
Yeah, an absolute cliff.
Right, and their total top-line revenue is, entirely flat year over year. So why has their earnings per share gone up for 6 consecutive quarters? I mean, the basic laws of financial physics just seem fundamentally broken when you look at this print.
It completely defies the traditional retail mindset, doesn't it? I mean, the old assumption is purely linear.
Move more metal, make more money.
Exactly. You move more metal off the lot, your revenue grows, and your bottom line follows. But what we're seeing here is a masterclass in decoupling profitability from sheer sales volume.
And that decoupling is exactly what we are tearing into today. Welcome to this special Talk Tickers edition of our deep dive. If you're holding AutoNation stock ticker symbol AN, or, if you're just eyeing it, the headline numbers rolling across CNBC do not tell the actual story of this company.
Not even close.
Right. So our mission today is to cut through that noise, pull apart the operational data from their Q2 2026 earnings call, and give you an actionable, opinionated bottom line on what is actually happening underneath the hood.
Because if you just skim the press release, you're missing the architecture of a massive financial engine. To figure out how earnings per share can grow while revenue just, stagnates, we have to isolate the specific levers management is pulling.
Yeah.
And it really starts by looking at the stark contrast on their income statement.
Let's get right into that data. Adjusted diluted earnings per share hit $5.56. That's a 2% increase year over year, which, like I mentioned, marks that 6th straight quarter of growth.
Right.
Now, in isolation, a climbing EPS suggests a booming business, right? People just flooding the dealerships. But total revenue came in at $6.93 billion. That is essentially dead flat compared to the exact same quarter last year. 0 top-line growth.
Yeah, 0. And in a high interest rate environment, a flat top line usually terrifies retail investors.
Oh, absolutely.
It implies stagnation. But look at their operational efficiency. SG&A selling, general and administrative expenses as a percentage of gross profit came in at 68.2%.
Which is down from what?
Well, in the first quarter of 2026, just 3 months prior, it was 69.8%.
Wow, okay.
Yeah. 160 basis point sequential improvement doesn't just happen by accident. They are aggressively stripping out costs to preserve their margin.
And you see that cash preservation in their adjusted free cash flow, too. $439 million for the first half of 2026. For anyone tracking their efficiency, that's a 125% conversion rate of their adjusted net income.
It's massive.
They are printing actual liquid cash. But, generating cash and cutting SG&A still doesn't fully explain the EPS paradox. You can't just cost cut your way to a consistently higher EPS if the revenue ceiling is totally capped at $6.93 billion.
No, you definitely can't.
So what is the actual structural mechanic driving the per share value up?
The structural mechanic is ruthless, aggressive share repurchases. It's a pure denominator effect. If management can't materially grow the total earnings pie because market conditions are keeping revenue flat, they have made the conscious decision to just rapidly shrink the number of slices.
Meaning they are just buying out their own shareholders to consolidate the remaining earnings.
Exactly. AutoNation deployed $457 million to buy back 2.3 million shares in the first half of 2026 alone.
Wow.
I mean, think about the scale of that. Through this buyback program, they have reduced their total outstanding share count by a massive 12% year over year.
12% in 1 year?
In 1 year. They're down to 33.8 million weighted average shares. When you wipe out 12% of the float in a 12-month period, every remaining share is suddenly entitled to a significantly larger portion of that flat revenue.
Wait, hold on. I got to push back on this a bit.
Sure.
Buying back 12% of your own stock in a single year isn't always this, brilliant sign of financial discipline. Sometimes it is a massive red flag. Doesn't this just signal that management is completely out of ideas for organic growth?
That's a fair question.
Right. Because if you have $457 million lying around, and you can't figure out a way to invest it into new markets, better technology, or expanding the footprint to generate more revenue, aren't you just using financial engineering to mask a dead end?
And that is the exact tension analysts zeroed in on during the call.
Yeah.
Is this a lack of imagination or is it extreme discipline?
Right.
CEO Mike Manley and CFO Tom Schlosek defended this not as a retreat, but as an absolute adherence to return on invested capital. If you track their ROIC over the last 6 years, AutoNation has grown it from roughly 9% to around 14%.
So they are vastly more efficient with the capital they do deploy.
Highly efficient. When they look at that $439 million in free cash flow, they have a strict waterfall for how to use it.
How does that waterfall work?
Well, they fund their mandatory maintenance capital expenditures first, about $325 million expected for the full year, just to, keep facilities updated and IT systems running.
Makes sense.
Then they look outward at acquisitions. But here is the critical part. If they evaluate potential dealership acquisitions and the valuations don't clear their 14% ROIC hurdle, they refuse to buy them just to artificially pump up the top line.
So they just walk away?
They walk away. They won't chase vanity revenue. If the absolute best return they can get for you is buying their own stock at the current multiple, that is exactly what they will do.
Okay, so the flat revenue isn't inherently a failure of imagination. It's a refusal to overpay for growth in a weird market.
Exactly.
But, you still can't execute a $457 million buyback unless the core business is throwing off massive amounts of cash. And this brings us to the actual floor of these dealerships. Because if volume is dropping, something structural has changed in how they make their money to maintain these margins.
And that structural change completely upends what most people think a car dealership actually is. To understand the AutoNation of 2026, you have to look at the profit engine, not the showroom floor.
Okay, lay it out for us.
The most critical data point from this entire report is that approximately 80% of AutoNation's total profits are now generated by highly recurring high-margin streams.
80%.
80%. We are talking specifically about customer financial services, which they call CFS and Aftersales.
Let's pull apart aftersales first, because the scale here is just staggering. When we talk about aftersales, we mean parts, service, routine maintenance, and collision repair.
Right.
This specific segment just delivered a record gross profit of $607 million for the quarter. Let that sink in for a second.
Massive.
Fixing and maintaining cars is the single largest contributor to their total gross profit, completely dwarfing the profit from actually selling the cars in the first place.
The consistency there is what provides the cash for those buybacks we were just talking about.
Right.
Within that $607 million, customer pay revenue, the out-of-pocket money paid for brake pads or oil changes that aren't covered by manufacturer warranty, went up 7% year over year.
Which points to really strong retention rate, right?
Exactly. Customers aren't fleeing to independent mechanics once their warranty expires. But if you want to talk about true operational brilliance, we have to talk about their wholesale parts revenue,
which spiked 16% in the quarter. I have to ask, how are they seeing a 16% jump in wholesale parts in a flat revenue environment?
By fundamentally redesigning their supply chain logistics. Think about how the franchise dealership model has operated for, the last 50 years.
Very siloed, right?
Highly decentralized and siloed. An AutoNation Ford dealership and an AutoNation Toyota dealership 10 miles apart would historically manage their own parts inventory, their own localized distribution, and their own commercial client list of local mechanics.
Yeah, they basically operated like totally independent businesses that just happened to share a parent company name.
Right, which sounds like an absolute nightmare for efficiency. You have overlapping routes, duplicated inventory carrying costs, and zero negotiating leverage.
So management looked at that inefficiency and basically tore it down.
Tore it down completely. They engineered a single, centralized virtual supply chain across all their brands.
So explain the mechanics of that for the listener out there. Let's make this real. If I own an independent collision repair shop in a major metro area, how does this change my interaction with AutoNation?
It changes everything. Previously, if you were repairing a Ford, a Honda, and a BMW in your shop, you had to call 3 different local dealerships, negotiate pricing with 3 different parts managers, and wait for 3 different delivery trucks.
That sounds exhausting.
It was. But now, you log into AutoNation's centralized system. They operate as a single vendor. You order the parts for all 3 vehicles through one portal.
Wow, okay.
AutoNation routes the fulfillment internally from their optimized network of regional hubs and delivers it in one consolidated shipment.
That is a massive operational moat. It's basically the Amazon primification of wholesale auto parts.
That's a perfect way to conceptualize it. By simplifying the procurement process for these independent shops, AutoNation is aggressively stealing market share away from non-franchise aftermarket suppliers and smaller, unnetworked dealerships.
Because they just make it so much easier for the shop owner.
Exactly. And furthermore, by centralizing the purchasing data, AutoNation can negotiate vastly superior volume incentives from the original equipment manufacturers, the OEMs. They are stripping out regional overhead, and maximizing margin on every single part that moves through the system.
Okay, so that perfectly explains the 16% jump in wholesale parts and how Aftersales is driving that $607 million profit. But Aftersales is only one cylinder of this 80% profit engine. The other half is customer financial services.
Right, CFS.
The CFS profitability came in at $2,800 per vehicle retailed. That is a 3% increase over last year, which honestly is wild considering where interest rates are right now.
It really is.
But the most interesting mechanism inside CFS right now is AutoNation Finance, their captive finance arm.
AutoNation Finance, or A&F, is scaling at a pace that demands attention. Their net income for the quarter jumped to $11 million.
And what was it a year ago?
A year ago, it was sitting at just $2 million. We're looking at a total loan portfolio that grew 52% year over year to reach $2.67 billion.
A $2.67 billion loan book isn't just a side hustle. I mean, that makes them a legitimate financial institution.
Exactly.
But originating a 52% larger loan portfolio requires a tremendous amount of capital. They can't just drain their own operating cash to fund billions in consumer auto loans, especially while they're spending hundreds of millions on stock buybacks like we talked about. So how are they structurally funding this expansion?
Through aggressive securitization. The A&F portfolio is now 91% debt funded.
91%.
Yeah, they pushed that up from 83% a year ago. The catalyst for this most recent quarter was closing a $550 million asset-backed security, or ABS, transaction in June.
Let's unpack the mechanics of that ABS transaction for everyone listening, because 91% debt funding sounds incredibly risky to a lot of retail investors, especially with consumer debt levels where they are. How exactly does AutoNation bundle and offload these loans?
Well, it's an arbitrage play at its core. AutoNation originates these auto loans at the dealership level, charging the consumer, say, 8% or 9% interest.
Okay.
Now, instead of holding those loans on their own balance sheet and tying up their capital for 5 years while the consumer slowly pays it off, AutoNation bundles thousands of these loans together into a massive pool.
Right.
They then sell slices of that pool to institutional investors as an asset-backed security.
So they get a massive influx of upfront cash from those institutional investors.
Yes. They might pay the institutional investors a 5% or 6% yield on the ABS, but they're collecting 8% or 9% from the actual car buyer.
I see.
AutoNation pockets the spread, minus some servicing fees, and more importantly, they immediately recycle that $550 million back into the dealership to originate a whole new batch of loans tomorrow.
That is brilliant.
It allows them to infinitely scale their financing arm without draining their own corporate treasury. And its working A&F accounted for 18% of all financed vehicle sales across their entire network this quarter.
Okay, the mechanics of the virtual parts warehouse and the ABS bundling show a company operating at a really high financial level. But let's bring this back down to the actual metal.
The cars themselves.
Exactly, because for all the brilliance in service and finance, there is a massive drag on the business right now, and it is the physical cars themselves. New vehicle retail volumes dropped 4%, sliding down to 63,240 units. And if you look closely at what is dragging that down, battery electric vehicles, BEVs, are in free fall.
The EV headwind is severe right now. BEV sales volume plummeted by more than 30% year over year.
30% is huge. What did management say about that?
Management was very clear about this. The early adopters have already bought their EVs, and the mainstream consumer is balking at the charging infrastructure, the range anxiety, and honestly, the price premiums.
Yeah, that makes sense.
But it isn't just an EV problem. Domestic unit sales, the heavy-duty trucks and SUVs from Ford, GM, Stellantis dropped 12%. Imports eked out a 1% gain, but the aggregate new car volume is simply shrinking.
And the used car side isn't really bailing them out either. The gross profit per unit, the GPU for used vehicles, is holding perfectly stable at $1,582. It has barely budged over the last 4 quarters.
True.
But when you look at the composition of that inventory, they are completely bifurcated.
Bifurcated is exactly the right word. They reported a 10% volume increase in used vehicles priced over $40,000.
Okay, so the high end is doing well.
Yeah, that higher end strength actually drove an 8% increase in overall revenue per unit for the used segment. The affluent buyer is still very active.
Yeah.
But the lower end of the market is an absolute desert.
Yeah, CEO Manley specifically called out the sub $20,000 price band. They literally cannot find affordable used cars to put on the lot.
Because the supply just doesn't exist right now. And rather than going to Mannheim or Odessa, the massive wholesale auto auctions and aggressively overpaying for subpar inventory just to have something to sell, AutoNation is choosing to take the volume hit.
That goes back to that discipline.
Exactly. They refuse to sacrifice their margin integrity to chase low-end volume.
I think this is the perfect moment to completely reframe how we view AutoNation's business model. Because when you stack these realities up, massive, highly engineered profits and service, centralized parts logistics, and securitized finance contrasted against shrinking volume and flat margins on the physical cars themselves, it forces a total paradigm shift.
I agree completely.
Everyone talks about the old razor and blades analogy for this industry, but I think that is outdated. AutoNation today operates much more like a freemium software platform.
A freemium software model. I like that. Walk through the parallels there.
Okay, think about a massive, complex app that you download for free, or maybe for a tiny, subsidized upfront cost. The developers aren't making their money when you download the base app, right?
Yeah, sometimes they even lose money on user acquisition.
Exactly. But once you are inside the ecosystem, you are bombarded with high-margin microtransactions, the in-app purchases. You buy the premium features, the storage upgrades, the cosmetic skins. For AutoNation, the physical vehicle, whether it's a new $60,000 truck or a used $40,000 SUV, is just the base app.
It's just the entry point to the ecosystem.
Exactly. I mean, the GPU on a new car is $2,381. On a used car, it's $1,582. In the grand scheme of a massive automotive transaction, those margins are incredibly tough.
Very tight.
The vehicle is effectively the freemium download. They sell you that car primarily to capture your data, lock you into their ecosystem, and immediately upsell you on the in-app purchases. The financing through A&F, the extended warranties, the GAP insurance. Management even noted customers are buying an average of 2 of these CFS products per vehicle.
And the recurring revenue stream of after-sales is basically a mandatory subscription fee on top of that.
Precisely. They want your brake jobs, your oil changes, your collision repairs locked into their centralized network for the next 10 years. The metal is just the vessel to secure the lifetime microtransactions.
It's a really compelling framework, and it aligns perfectly with how management discussed their pricing strategy during the Q&A.
What did they say?
Well, an analyst pressed Manley on whether they were intentionally sacrificing initial unit margins to maintain volume in a tough market. Manley didn't hide from it at all. He explicitly focused on customer lifetime value.
Interesting.
He stated they are constantly balancing the customer acquisition cost. If they have to accept a compressed front-end margin on the car to win a customer who will subsequently generate thousands of dollars in high-margin service and finance revenue over a 5-year life cycle, they will take that trade every single time.
Okay, so they've engineered this incredibly lucrative freemium ecosystem, and they are using the cash it generates to aggressively buy back stock. But you can't shrink the float forever, and you can't ignore the macro environment forever.
No, eventually you hit a wall.
Right. That puts extreme pressure on their forward guidance. Let's look at what management is actually projecting for the rest of 2026.
The loudest drumbeat in their guidance was continued cost efficiency. We touched earlier on their SG&A dropping to 68.2% of gross profit. Management is projecting they will squeeze that down even further, targeting a run rate of 66% to 67% by year end.
To hit a 66% target in this inflationary environment, you can't just be cutting back on complimentary coffee in the waiting room.
No, definitely not.
They have to be aggressively slashing major line items. How exactly are they pulling that much cost out of the system?
The primary lever is advertising discipline. Manley noted they invested heavily in top-of-funnel marketing in the first half of the year to combat the volume slowdown, but they expect that spend to moderate significantly in the second half.
Okay, advertising is a big one. What else?
Furthermore, they are engaging in what they euphemistically call portfolio actions.
Which is corporate speak for pruning the dead weight, right?
Exactly. Selling off underperforming franchises, exiting unfavorable lease agreements on real estate, and consolidating headcount where that virtual supply chain we talked about has made legacy roles redundant.
But the piece of guidance that really stood out to me wasn't the cost cutting. It was their projection on inventory supply. We just detailed how desperately they need affordable used cars to feed the ecosystem. Management stated they expect off-lease vehicle supply to accelerate 30% to 40% in the second half of 2026 compared to the first half.
This is the critical inflection point for their used car business.
Really? Why such a massive jump?
Well, to understand why off-lease supply is suddenly jumping 30% to 40%, we have to look back at the mechanics of the COVID hole, which Manley directly referenced on the call.
Walk through that timeline for the listener because it's fascinating.
Okay, think back exactly 3 years prior from this 2026 earnings call, so 2023. During the depths of the pandemic supply chain crisis, there were practically no new cars on dealership lots.
Right, because of the chip shortages.
Exactly. And because there were no new car leasing completely evaporated. Nobody was signing leases. Fast forward 3 years, which is the standard duration of an auto lease, and you hit an absolute vacuum of vehicles returning to the dealership.
Ah, I see.
That vacuum is what has been starving AutoNation's sub-$20,000 used car inventory for the last 12 months.
But now we are finally crossing the 3-year anniversary of production restarting and normalizing. The leases written during that early recovery period are finally maturing.
Precisely. The cars are finally coming back. And understanding why an off-lease vehicle is vastly superior to a vehicle bought at a wholesale auction is totally crucial for evaluating AutoNation's ROIC.
Break down the margin advantage there. Why is internal sourcing so much more profitable than just going to an auction?
When a customer drives their leased vehicle into an AutoNation service bay at the end of their 36-month term, AutoNation gets the exclusive first right to buy that vehicle directly from the captive finance company at a preset residual value.
Okay, so they skip the middleman.
They completely bypass the auction fees, the transportation costs of hauling a car across the state, and the sheer unpredictability of bidding wars at Manheim. Furthermore, because that leased car was likely serviced at that exact AutoNation dealership for the last 3 years, they already have the entire telematics and maintenance history.
So the reconditioning cost is incredibly predictable. You aren't buying a lemon.
Highly predictable. And the time to line, the speed at which they can turn around that car, clean it up, and put it on the front line for sale is drastically reduced. Currently, AutoNation sources roughly 90% of their used vehicles internally through trade-ins or lease returns.
That's a huge competitive advantage.
It is. So that 30% to 40% jump in off-lease volume is going to supercharge their most profitable inventory channel right when they need it most.
Okay, that covers the supply side beautifully. But what about the demand side? We hear a constant barrage of negative macro data out there. Persistent inflation, credit card delinquency spiking, the struggling middle-class consumer. Yet AutoNation's management seemed like entirely unfazed.
They were actually quite bullish on the consumer. They pointed to the June SAR, the seasonally adjusted annual rate, which tracks annualized industry sales volume hitting a 4-year high.
That is surprising.
And beyond the raw volume, their banking partners reported a 20% year-over-year increase in auto loan applications and originations. They are also seeing a stabilization in delinquency rates.
So the consumer is holding up better than the headlines suggest.
From Manley's perspective, the combination of slight transaction price cooling, increased OEM incentives, and steady wage growth has created the most favorable affordability matrix since before the pandemic.
Okay, I have to throw some cold water on this. I understand the SAR is up and off-lease supply is returning. But I look at the strategy of prioritizing customer lifetime value, of treating the car as a freemium-based app and relying on the in-app purchases of Aftersales, and I see a massive vulnerability if the macro environment actually cracks.
Okay, what's the bear case?
If we hit a severe recession, consumer behavior shifts instantly. The first thing people do when budgets tighten is delay discretionary spending. Doesn't that mean they delay servicing their cars?
A logical assumption.
Right. They ignore the check engine light. They stretch the oil change from 5,000 miles to 10,000 miles. They put off the $800 brake job. If AutoNation is eating compressed margins on the initial sale, relying on service revenue that suddenly dries up in a recession, doesn't this entire highly engineered ecosystem just collapse?
It is the ultimate stress test for their model. If service revenue is entirely discretionary, your bear case is spot on. But management's counter-argument is rooted in the physical reality of the U.S. vehicle fleet right now. The average age of a car on the road today is over 12.5 years.
Which is a historic high, right?
A historic high.
Meaning things are going to break whether you have the budget for it or not.
Exactly. You can only delay maintenance for so long before the vehicle physically stops functioning, preventing you from getting to work. AutoNation views a massive portion of their after-sales revenue as non-discretionary.
Because at 12.5 years old, a car isn't just needing an oil change, it's needing major component repairs.
Right. Furthermore, they are actively hunting the aging vehicle demographic. They have designed specific service packages and centralized parts logistics to target what they call the 3 to 10-year park vehicles that have aged out of their original warranties.
Ah, so they are going after the independent mechanic's core customer.
Yes. They know they have to compete with local independent shops on price for these older vehicles, but by leveraging that centralized virtual parts warehouse we discussed, they can lower their cost basis enough to offer competitive pricing while still maintaining their margin. They are insulating themselves against a recession by becoming the most efficient repair network for an aging fleet.
Which brings us to the most critical juncture of this deep dive. We've dissected the share repurchases, the virtual supply chain, the ABS funding, and the freemium strategy. If you're a retail investor tracking this stock, what is the talk ticker's bottom line?
Based on the structural mechanics of their profit engine and their capital discipline, the verdict for retail investors has to be a definitive bullish stance.
A bullish stance on a dealership group with flat top-line revenue and plunging EV sales. The justification here has to be airtight.
The justification rests on two pillars. The first is absolute insulation. AutoNation is heavily insulated from the cyclical volatility of the auto industry. The headlines scream about EV demand collapsing and domestic truck sales dropping 12%. But AutoNation just printed its sixth consecutive quarter of EPS growth.
Right, because of the recurring revenue.
Exactly. When 80% of your profitability is derived from financing, fixing, and maintaining an increasingly old national vehicle fleet, you are no longer a cyclical retail stock. You are a defensive, highly recurring service business disguised in a cyclical shell.
The market looks at the dealership sign and assumes extreme cyclical risk, completely mispricing the stability of the after-sales engine underneath it.
Exactly. And the second pillar is that management has transformed the company into a ruthless capital allocation machine. They are generating $439 million in adjusted free cash flow and executing a dual threat deployment strategy.
Explain the dual threat.
Well, they aren't just buying back stock. They are strategically acquiring density. Look at their recent M&A activity. They bought a massive Toyota store in Georgia and 3 premium luxury stores in the San Francisco Bay Area.
And because of that density, they can plug those 4 new stores directly into their centralized virtual parts warehouse, instantly stripping out local overhead and immediately boosting the margin profile of the acquisitions.
Right. Those 4 stores alone are projected to add $600 million in combined annual revenue.
Wow.
So they're systematically buying high-performing assets in dense markets, integrating them into their high-margin logistics network, and simultaneously using the excess cash to retire 12% of their outstanding shares in a single year. It is a compounding loop of financial efficiency.
So if you are looking at AutoNation today, the actionable intelligence is this. Do not analyze this stock by looking out your window to see if your neighbors are buying new cars. The raw volume of metal moving off the lot is a distraction.
A total distraction.
AutoNation is attractive as a bet on management's extreme ROIC discipline, their ability to monopolize the high-margin logistics of auto repair, and their willingness to financially engineer continuous EPS growth.
You aren't betting on the popularity of the freemium app. You are betting on their absolute mastery of the in-app purchases.
Which leaves you with one final, slightly provocative thought experiment to mull over as we close out this deep dive. If AutoNation is already extracting 80% of its profit from financing and fixing cars, and if management is openly willing to accept compressed margins on the initial sale just to lock a customer into that highly lucrative ecosystem, are we approaching a future where the actual physical car is intentionally sold at a loss?
The ultimate loss leader.
Exactly. Think about where the industry is heading. Vehicles are becoming incredibly complex, software-defined machines that local independent mechanics simply cannot repair without proprietary OEM diagnostic tools.
Right, the mom-and-pop shops get priced out of the repair market entirely.
As that technological moat deepens, AutoNation's monopoly on the repair revenue of their customer base only gets stronger. It forces you to wonder, in 10 years, will the car itself just be a 2-ton metal Trojan horse, subsidized or sold at a loss, used solely to harvest a decade's worth of consumer data, securitized loan interest, and guaranteed maintenance fees? It completely redefines what a dealership actually is.
It suggests the physical vehicle is just the hardware required to sell the software and service subscriptions.
It really does. And with that, we want to thank you for joining us on this Talk Tickers deep dive. You are now armed with the actual mechanics behind the AN ticker, and hopefully that seemingly paradoxical earnings report makes perfect mathematical sense. Until next time, keep looking past the headlines and digging into the data.